Does it ever concern you with having so much debt, say in a downturn, for example, like 2008 crash?
So I kind of built the business so that I wouldn't be in that position, because from years ago, a mentor of mine, the only thing that had really almost tripped him up was HSBC in 2010 said to him, right.
So in our lifetime, do you think perhaps you and I are ever going to experience a time where people stop having faith in fiat currency, which brings this whole system down?
Will people lose faith in money? I don't know, because there is no, what's the substitute? Crypto's not the substitute, because what happens if Bitcoin or Ether is to become the reserve currency of the world? Well, there's only a fixed supply of it. So the price just goes up and up and up and up and up and up like this. And then people are priced out. They're crowded out of the market.
Adam, thank you so much for joining us here today on our podcast. Now, obviously, you have done a lot for yourself in the real estate world, that you've expanded into different sectors like care homes. We're just talking about a bowling alley and a bakery as well. But I want to go back a little bit and see what your beginnings were like and what really got you to put your first foot onto the property ladder in the first place.
So, accidental landlord from 2008, where I moved out of a property that I was sharing with my partner at the time, and we found out we couldn't sell it. We'd made all the mistakes you can make in one go. So we bought it in 2006, pretty much the top of the market. It was a new build. We paid the asking price. We part exchanged her house at the time into it as part of the deal. So that's where we probably got a bit of value. But we were left with an asset that by 2008 had actually dropped in price. Couldn't sell it, and decided, right, we didn't want to take a loss. So we decided to rent it and had an agent to rent it out for us. Agent didn't seem to be doing the best job in the world. It's typical old story. Thought, right, I can do a better job myself. I think they wanted to charge us 300 quid for changing a part in the washing machine. I just thought, could just have a new washing machine for that price. Why am I paying an agent 10% for, and took over the management of that. And then that went pretty well, because apart from anything else, when 2009 came, the interest rate dropped through the floor. We were on a tracker mortgage, a base rate tracker. So that property has been really quite profitable over the years, until the recent changes in base rate, as you know. And then the profits started to go down and down and down.
So what did you do before then?
So before that, I actually worked in wealth management. I lived in Geneva in Switzerland for a couple of years doing that, worked for a couple of boutique firms. And other than that, I've always worked for myself. So I actually ran a sports betting operation that was to do with sports arbitrage. So we would place bets and effectively trade them in the same way that an options trader would trade options. I would do the trading, and I would have people who put bets on who worked with me, and we put ourselves in basically zero risk positions, which we did for quite a while. That was quite lucrative, and ran alongside everything else I was ever doing. So a few other entrepreneurial bits, but that's pretty much been it. No corporate career of note apart from a few years worth of financial services.
Well, that's so interesting, because I've never met someone do that before. Sure. Do you think the skills you may have learned on that job may help you or be relevant in what you do in property?
I think so, because it's about risk management. Because even when we used to say there was no risk, what it really meant was whoever won the football match or whatever the event was that we'd bet on, it didn't matter, because we made an equal amount of money regardless of the outcome. So people call it zero risk in those situations. But it's not really zero risk, because you still have risks. If you go and you had risks of the counterparty not paying you, so the bookmaker not paying out. That happened to us a whole number of times. If you had to place bets in cash, as we were forced into doing after a while, because we got our accounts closed, because bookmakers are businesses and they don't like people winning money. So if you're walking around placing bets in cash, you've got security risk. You've got an operational risk. What if one of the guys ticks the wrong box on the slip or whatever and gets it wrong? So you've got all sorts of operational risks you've got to consider. And so whilst there were, it was seen as zero risk, there was a lot of risk management to do. And that was very similar to what I did in financial services, because managing portfolio risks and the risks of investments going down, I didn't work in the industry, and I'd left before 2008, but I know that our portfolios didn't lose that much money, which in a year like 2008 was a fantastic result, where other people were losing 30 and 40% or lost their whole business or whatever, we were down about 6% apparently. So pretty good results. So risk management, comes through into property, because you've got interest rate risk like we've been talking about, like we were dealing with at the moment. You've got risks of working with contractors, not doing what they say. We were talking earlier on about planning, weren't we? Risk of planning, not doing things in a timely fashion. You've got all sorts of things to consider. And not all those risks can really be insured against effectively. So often you have to be quite tight in the management of things to make sure that things don't slip.
Fair enough. I don't think I've seen anything that has rewards but no risk. Everything has risk.
Yeah, absolutely. I mean, even at the moment, I guess you could argue, the government bonds return, people are getting 4, 5, even 6% over the last 12 months if they've invested in government bonds. But you'd be a fool if you thought there's no risk in a government bond, because the government's got money until it hasn't, right? And so, of course.
Fair enough. So what led you to become a full-time property landlord then? Because you took on your first property, an accidental landlord. You managed it yourself because you weren't happy with your managing agents at the time. What next?
So that was 08, right? And I was watching the market. I wasn't really too engaged with the market before then. Like most people who owned a property, had a house, was happy to be on the ladder, didn't have any designs to move particularly. And then, as I say, things change in a relationship and suddenly everything changes, doesn't it? And I thought, right, actually, it looks like quite a smart time to go into rental, as into a rental myself and rent that other property out. Because I was watching the prices were falling. The headlines were terrible. There's blood on the street, effectively. And I didn't have cash to buy properties at the time. So I thought, well, I'll just wait and I'll see what happens. And I managed to get a property in 2009 and negotiated on it in May, a property that I really wanted to live in, and managed to raise the finance for that in a fairly creative way against other things that I was doing. Obtaining credit lines where I couldn't get a traditional mortgage at the time because I was effectively self-employed, right? Managed to get the money together to do that deal, and it was a house that had been on the market at 450k in 2008. We managed to buy it for 320. So around where I live, Solihull, it's not that easy to get deals of that sort of quality. Of course, the market did most of the work, right? And I just did the last little bit, and that was a pretty good deal. And then when I could get finance, which was fast forwarding to 2011, 2012, I managed to raise some finance against that property and then restructure the creative credit stuff I put together. And then I had some funds to put into property. And I just looked at the market and thought, right, prices are down, whatever number you want to believe really, but say 20% probably around South Birmingham, around that sort of time. And rents were going relatively strongly because lots of people were renting. They weren't buying, they were waiting. Or they couldn't, like me, they couldn't get mortgages. So they were having to rent. So rents look good and look like they should rise over time. Population growth and all the general demographics for Birmingham and the surrounding area look pretty positive. And there are already businesses talking about moving up from London and all the rest of it. There was already, people talking about high-speed rail, although that's another interesting subject. But it was, there were thoughts in the pipeline around that. And I thought, right, where can I go where there's some yield? Because I wanted cash flow. So that lack of cash flow is what kills every business that fails, So where is there going to be cash flow? And I looked at a couple of high-yield areas where I thought there would also be some capital growth. So I settled on Tamworth, northeast Birmingham, and Nuneaton in Warwickshire, and bought some properties there with some JV partners. So I thought at the time didn't really have skills, didn't know anything about building, didn't know anything about projects, particularly project management. So roughly understood, had some business skills, understood how to make money. That was about it really. So partnered with a couple of people and then invested some money in a couple of HMOs, started trying to buy below market value. Spent a long time working out, was it a real thing? Was it just something people talk about? Why do people sell below value? And found that on the open market with enough legwork in a flat market at the time, it was actually possible to buy stuff, between 10 and 30% discounted, and did okay on those first few, but very quickly ran out of money, didn't have the skills and the smarts to raise more money at the time. So then thought, right, what do I need now? Well, I need a partner who's got significant amount of capital to put into a project realistically, and went out and found one. And that was fast forwarding more to about sort of 2014. So by then I'd been involved in 8 or 9 projects, felt like I knew what I was doing, knew how to buy reasonably well from the open market, and thought, right, and as I said, you got to bear in mind the market was pretty soft at the time, right? So it wasn't that hard to buy pretty well. My target, I remember at the time, was to try and buy houses at about the price that they traded at in 2004. So I was kind of getting about a decade for free, really. That was where I was thinking about it, which was good. If you could do that stuff in 2013, 14, that was good numbers, rolling back 10 years. Because even though obviously it come off the top a lot in 2008, in 2004, there was a lot of growth between 04 and 08 before it hit the buffers,
So I presume you quit your job between that first property and your second property. Is that somewhere where you quit your job and became full-time?
So my sports arbitrage stuff was very up and down. So we started getting banned from a lot of bookmakers, even from placing physical cash bets and things like that. So that outlet became more difficult. I went and did a master's degree in business administration at Warwick University. Went into a job after that and left that fairly quickly once I'd secured the joint venture investment with my business partner.
Because what I'm thinking is, if you've quit your job, you've invested your own capital into a property already, were you selling the properties at all? Or are you just having cash flow?
No, just cash flow.
So if you're having cash flow only, where do you source the funds? What was your strategy to expand that into the non-projects you have now?
Yeah, so I always tried to make my money not from property, as in my walking around money. I always tried to have something on the go, another business, a side hustle, whatever, that was bringing in enough money such that I didn't need to drain it from the portfolio, so that I could always reinvest the funds that came in from cash flow. So very early on, I was involved in limited company structures before Section 24 or any of that, because apart from anything else, the mortgage lending landscape at the time was very, very weak. So there were only a couple of lenders who were really interested. And I thought, well, if I want to build a big portfolio, then how am I going to be able to do that? And then another thing that I did was I borrowed from private individuals, from investors, against the cash flow that I created in those companies. So I said, right, so this property's making £1,000 a month, let's say, so I can afford to service £500 worth of interest on that.
At what yield would you buy the loan for?
What would I pay on the... So about 1% a month, I think I was paying at the time, something like that, roughly. So if I could do that, if I could sacrifice £500 a month, I could borrow 50k. As long as I could turn that 50k around and recycle it, it wouldn't be a problem.
And would you give them security on your shares?
Generally speaking, no, I didn't give them share charges or anything. I didn't really understand share charges at the time, if being honest, and nobody asked. So no, I didn't. But I made sure I didn't do anything crazy like borrow 3 times against the same property or stuff that other companies and people have done in the past. So
fast forward to today. Do you sell anything now?
I've sold quite a lot in the last 18 months, yeah. And so I went a long time without wanting, very fixed mindset, I want to build, I want to buy, I want to refurb and create units and make a bigger and bigger and bigger portfolio. And then the way the market was sort of early 2022 and the way that I got very much into studying very closely what was going on politically and in the economy, especially during the pandemic. So I felt I had a pretty good handle on what was going on. And I thought, right, okay, inflation's coming. I've been talking about inflation for about the last 3 years nearly now, when people have only been talking about it as a proper thing, probably for 12 months, because until then, the Bank of England and everyone was saying, well, it's just a transitory thing, it's going to pass. And it's like, it's not going to be like that, So because of the way the market was, I thought, right, this is a good time to review quite a lot of stock in the portfolio, because generally speaking, we've gone and bought where the deals were, rather than thinking, right, I'm going to buy in Birmingham. Didn't really think like that. I thought, right, I'm going to go where the deals are. Where are the deals where I'm going to be able to recycle my cash? Right, if they're in South Wales, I'm going to South Wales. As long as I've got a reasonable, positive view on the future of what's going on in South Wales. Even if I haven't got a positive view, that just means I'm going to need a really good deal to go there. So if you can buy a property somewhere where you maybe don't want to buy one, but it's at a 50% discount, you're probably going to consider buying that property. Although you might decide to flip it on pretty quickly rather than hold it. But the beauty of that is you can sell it at a 30% discount and you've still made a margin. So I've generally gone where the deals were, and I looked at what was in the portfolio and thought, right, do we want to own some of this stuff in 10 years' time? Right, probably not. It's probably done its job. I mentioned South Wales then, but I actually targeted South Wales after the 2016 referendum because I thought the prices went down quite a lot and the toll was coming off the bridge between Bristol and Wales, coming off the Severn Bridge. And, you know, we're funny about toll roads. We don't like paying for them. But with the toll road gone, I thought, well, Bristol was massively increasing in price. It was very hot. It was very difficult to buy around there. So I thought, well, South Wales is nearby. You know, it's 20 odd minutes from Newport to Bristol, and you can buy a 3-bed semi on the open market for like 130k, and you can get the equivalent property for about 300k in East Bristol. And I thought, well, you know, people are now going to start moving. It's going to mean there's basically arbitrage between the two regions. And so I bought in quite heavily to South Wales and bought some good deals down there. But Wales was the biggest rising region of the UK during the pandemic. And I thought, well, it's probably now gone further than I would expect. The governmental changes are a bit of a concern because they're going to probably ruin the private rental sector with the way they're going to regulate it. In honesty, that probably makes you a winner in the long run as a landlord, not a loser. It's really the tenants that suffer. But I looked at it and thought, you know what, I wouldn't mind trimming down what we own down there. And then every time something came up that came void organically, I just thought maybe we'll sell it and take advantage. You know, we were selling 10%, 15%, 20% above what we thought these properties were worth. And you don't see those markets come along every day. So I just thought, right, offload those. We actually had plenty of opportunity to replace those units with other deals that were in the pipeline. So we didn't actually net sell off, but instead of, say, buying 30, we bought 90 and sold 60. And it's
very interesting how you've highlighted what made the prices go up in Bristol, because that's how real estate works, right? Demand and supply. But it's all well and good when someone wants to expand their portfolio with the investment or the capital they already have. But to grow more, at one point they are going to run out of cash. So it comes down to two things. Either they're going to sell off their portfolio, sell some, retain some, and expand and recycle that cash like what you just said, or raise finance.
Yep.
What do you think is the preferred route for yourself, or one should consider perhaps doing?
Well, I've raised finance in a couple of ways. As I was saying, I used to raise some against cash flows and things like that. So I know most people sort of concentrate on project finance, and their idea is they're going to find a building, they're going to add value to it, and then they're going to be able to pull out all the funds when they refinance it and pay the investors back. You know, that's the typical route that people will take. I've kind of blended that with people who've wanted longer term investments and been willing to take lower rates, but they haven't got to worry about not getting the money back, or they haven't got to worry about redeploying it. It's all very well to get 1% a month. Let's say that's the number that people tend to quote for whatever reason. But if you get 1% a month, but your money's only deployed half the time, you're only getting 6% a year. Then if you've got credit problems with getting the money back from the person you've lent it to, you know, I've had so many conversations with people who've come to me in the first place and said, do you want some money? Do you want me to lend you some money? And then they'll say, but I had trouble getting money back from this person or that person. I'm like, well, A, you came to me, and B, you know, what security did you have? What did you know about lending money? And unfortunately, a lot of them didn't know a lot, you know. So I try to help and try to be transparent and honest with them in those situations.
Yeah, I suppose it depends. It comes down to whether one is looking to just expand their portfolio for generational wealth and just have good cash flow, or are they actually trying to increase their wealth? Because in hindsight, you could do that, buy a property, refurbish it, refinance, pull out your money. Or you could buy it, let's say a piece of land for 300, use development finance 700k, build 10 flats, 1 million, sell it for 1.3. In 12 months, you've made 300,000 on your investment of 300. That's 100%.
Yeah.
So you've got 600 now to go again.
Yep.
So I guess it does come down to that if you're looking to build wealth, or just property which gives you cash flow for the rest of your life.
Or do you want to do a bit of both? Absolutely. Yeah.
Exactly. So how do you spot your opportunities then that you like to invest in?
So early on, as I was saying earlier on, you know, did a lot of legwork, speaking to agents, finding deals. And as I said, there were a fair few out there in the market, just as there would be today if you go and put the hard yards in. Then sort of graduated, if you like, to buying at auction. So I started buying after auction. That was relatively easy because 7 out of 10 times probably the stuff that was left after the auction was because the price was too high. Doesn't mean they won't negotiate afterwards. of course. And then, 3 times out of 10, there was something quirky that the auction room didn't like, or I noticed these factors. Maybe the listing was wrong. If it was marketed badly, that was a really, really good opportunity. The best one we bought, I think, from a numbers perspective, was a flat that was in pristine condition. It was down in the southwest, and it had a sea view. The sea view was obstructed by a tree, so it didn't have a sea view. But the tree didn't have a TPO on it. So we looked into it and thought, right, okay, what do we need to do here? Cut down the tree. It was sold in auction in perfect condition. The auction room doesn't like stuff in perfect condition. It's expecting to see stuff that's wrecked so it can add value to it. Bought it at a great price. I think we paid $160 for it. We let it for about 18 months. It was going to be quicker than that, but the pandemic got in the middle of all of that, and we sold it for $293K. We hadn't done any work to it apart from cutting down the tree, which cost us 800 quid. So you can get some fantastic deals after auction. That was there for everybody to see. And then I started building relationships with property traders. So some of the volume wholesalers like We Buy Any Home and people like that. It's a relatively small circle. Made it clear that I was happy to pay fees. I would give quick decisions. Got to somewhere near the top of their black books, if you like, relatively quickly, and was able to do lots of volume. And that model worked really, really well up until the pandemic, where a lot of them not necessarily shut down their operations, but they paused because there was no stock. And then the game changed quite a lot. So some of them started buying for themselves. They didn't want to go to market. They wanted to hold on to it because they saw what the market was doing. So I've done well with traders over the years at different points in the cycle. So in it really, and direct to vendor as well. We've done some offline, but mostly online solutions for direct to vendor. And that game is really twofold. One, run a sales and marketing business, which is not my strengths. And I know people who spend upwards of 50 grand a month. Some of them spend 150 grand a month on TV ads and absolutely everything. And they do, 60 to 120 deals a month. I mean, they're doing serious volume, and they'll take, maybe 10K, 15K average profit out of each one. But sometimes they're doing that on the same day. They're doing it with clever structures that mean they don't even have to own the property. They're not having to pay the stamp duty. They just got a legal bill and a nice juicy bit of revenue, although they spend a lot on marketing, like I said, and sales.
Fair enough. So what's your view on debt? When you're servicing all your properties, are you looking at interest only, or are you paying back principal?
So generally speaking, I like interest only. And if you want to then pay down, then choose where you pay down. So I would rather have a 75% geared portfolio and have 10 or 15% as liquidity than have a 60% portfolio and be broke, like quite a few people are at the moment because of the way the interest rates have been. So I think you can look, and usually you've got that room to pay 10% every year down. And I would say target, in a portfolio level, I always tell people to target a certain small slice of properties to be unencumbered. So if you want a 60% LTV portfolio, you would be better off with 80% of your portfolio at 75% and 20% unencumbered, because then you can bridge against those unencumbered assets, and those unencumbered assets will be returning you a better return than if you had the cash in the bank. So if you know what you're doing, you've got good relationships with fast funders, you can raise the money against those in a week. So it doesn't stop you from doing any deals. It's as good as cash, but it's not cash. It's sitting there earning rents. So I think strategically, I know a lot of people disagree with this, but I looked at the biggest corporations in the world, and I don't mean like the Apples and that necessarily, because they make so much money, although they still have debt. They still have debt as long as the debt is at the right price. But I mean the ones that have been around for many years, like BP, for example, they have a big old slab of corporate debt. And why do they need it? They make so much money from selling oil and all the rest of it, but it's because it increases their returns on equity. So if the debt is priced correctly, then instead of getting, and it works with the unencumbered properties, let's say you were getting a 6% net yield out of an unencumbered property, but as long as you can borrow the money cheaply enough, you can gear that yield up to 10, 12, 15% if the price of the debt is right. If the price of the debt is more than 6%, then you won't be able to do that. So there's good debt and bad debt within the confines of that conversation, but last year I was posting a lot about how the interest rates were going to go, and it was a good time to fix, and took my own advice, if you like, and broke around about 200 mortgages, paid early repayment charges on them, and refinanced them at the rates when they were still sort of threes, mid 3%, some at sort of 4%, because it took time to do all that, as you can imagine. And I'm so glad we spent that money now, because those have got a 5-year runway of nice, low fixed debt.
Does it ever concern you with having so much debt, say in a downturn, for example, like 2008 crash, that a lender would turn up to your door and if you're negative equity asks you to bridge the gap and you don't have the capital for it? Being so leveraged out with debt, does that ever concern you of a moment like that?
So I kind of built the business so that I wouldn't be in that position, because from years ago, a mentor of mine, the only thing that had really almost tripped him up was HSBC in 2010 said to him, right, we are activating our clause, which gives you 3 months to repay. Not that he was overgeared, he's only 50-something% loan to value, even at the adjusted prices, if you like. But they said, no, we're getting out of UK property. We're not interested in it. They'd obviously taken some big losses or whatever. You've got 3 months. And at the time, because credit conditions were tight, there was only really Lloyds and Handelsbanken in the market for lending on portfolios. So he had a lot of sleepless nights, 30k in legals and surveying fees and all the rest of it to move the portfolio over. And he got it done within the time frame. But that taught me a couple of lessons, really. Number one, don't put all your eggs in one basket. So don't just have one lender. Have as many different lenders as you can. So even over a portfolio, a much more ideal structure would be 4 or 5 lenders against chunks of the portfolio. Even though they all want to be the only lender, it's not a good idea. But secondly, try and stay away where you can from those sort of commercial loans where they've got the clauses in there. Now, when I say 200 mortgages, that's because we had used the individual property single mortgages, which don't have the clauses in to say they can revalue and ask you to post capital. So once it's fixed for 5 years, it's fixed for 5 years, and it's securitized and it's gone away. So I tried to take that risk out of the portfolio, because that's a risk you don't get paid for. So you do have to consider that, and you do have to consider you might go into a mortgage at a good time in the market, and then when it's coming up, it might be a credit crunch situation. So you've got to actively manage the debt, and it's a big job, So you are thinking about, right, okay, say this mortgage is going to expire in mid 2025. I'm thinking 12 months ahead. Right, we're going to try and sell it and not leave ourselves no time. So we're going to try and sell it and pay the early redemption penalty if we sell it early. Maybe we will. Let's see what the market looks like next year. And just basically playing. But in fairness, the way that the valuations tend to work, and then so we've sold a property where we thought we'd had a fairly low valuation and sold it 10 or 15% more than the valuation. It's not uncommon. So the surveyors tend to suppress the prices and keep them down anyway. But I'm not advocating, our loan to value is somewhere around the 55% mark. And I think that's a good corporate approach to debt, rather than a 75% completely, you've got nowhere to go if you need to raise capital.
Do you not get tempted to push it to 60 or 70%?
Depends on the timing, really, but it's quite difficult to do that because of these individual loans, I've structured things with a 5-year cycle. So when I said last year I broke 2 years worth, there are still 3 years behind that where they've been valued. So let's say where we are today, end of 23. So if I had something valued at the end of 2019, or I had some of them have got mortgages longer than 5 years and they've got 7 years or whatever on there. But if I had it valued in 2019, what's the loan to value today? The market's up. Even the worst case scenario, the market's up 20% since then. So if I got 75% on a mean valuation in 2019, and it was worth, let's say, keep the numbers easy, it was worth 110. The surveyor said it was 100. We borrowed 75. So 110 today, it's worth 130. Let's say we owe 75. We only owe, 50-something% loan to value. So we can't. That methodology stops us from over-gearing anyway. And then if we need to sell it, and if we need to take a 10% discount because we need to move it quickly, or something unexpected is wrong with it, or it needs a new roof and we don't want to put the capital in for a new roof, we can sell it and we can take that hit, and we've still got the capital growth, and we've still got a nice bit of equity in there as well. So we're still going to walk away with quite a bit from the sale.
It's really great to see how you've got all your principles and methods already laid out on how you do your investments. It sounds amazing because you need that. especially in this game, because it's like in auctions, people get tempted with the bidding of it, and it's all psychological. It's true, it is required. But something very interesting I read recently. Since the 2008 crash, the Feds have printed $186 trillion of debt to increase the GDP of the country by 46 trillion till date. So that's again 186 trillion printed, which only resulted in an increase of 46 trillion. So that tells me that if the money was not printed, then either we would have been growing our GDP in a very slow pace, or we would have been going in a downturn, which is, it's a food for thought. Then does that mean we are in this large, massive Ponzi scheme, which is a bubble being fueled by and stimulated by all this printing of money that's going on?
Well, I think there's two ways to look at that, really, because, money is about belief. You have to believe that what it says on a £20 note, that we will pay the bearer on demand the sum of £20, right? You've got to believe that's true. Otherwise, you and I can't barter or exchange anything with money because we don't believe it's worth anything. And this is why when everything goes wrong, like a pandemic or whatever, the Chancellor of the Exchequer, the Bank of England governor, they're on TV saying, we'll do whatever it takes. We will do whatever it takes, because they have that ultimate power to be able to press a few buttons and create some money and work something out and stimulate the system, whether that's stimulating a bank or a company or corporate bonds, or whether it's money directly to members of the public, which happened a lot in the US, where, Donald Trump sent them a check that he'd signed himself, or that happened a couple of times, pumping money. They call it helicopter money. It's pretty much the most extreme thing that a central bank can do. But generally speaking, the UK PLC is the best business in the country, right? The tax receipts are nearly £1 trillion a year, so they're pretty solvent, and they spend around about somewhere between 2 and 7%, depending on the rates and depending on the year, of that receipt, of that revenue, on servicing the debt. So if you go back to my point about someone like BP, they don't pay the debt back. They don't ever intend to pay the debt back. They just roll the debt. They roll the debt. And that's exactly what happens at a governmental level. So debt gets measured in funny ways as a percentage of GDP. For example, the world's quite keen on that. So, we're at like 105% at the moment, 102% I think we are. The US is worse. The US is about 115%. The US has the privilege of having the mighty dollar that oil is traded in and gold is traded in and all these other things are traded in. And although there's lots and lots of theories about, Russia and China coming together and creating a digital currency that will knock the dollar off its perch or whatever, it's difficult to see how that will actually manifest itself when you've got a country like China who doesn't want the yuan to be leaving, doesn't want it to be traded internationally. It has capital controls. There's less money traded daily in yuan than there are transactions in China. So there's transactions going on in China in dollars and other currencies, because you can't control the capital in the way that they want to and then have it as the world's reserve currency. It's not a possible thing. But then they run a surplus because so much of what they do has been goods related, whereas the UK and the US run a deficit because it's services related. And also money flows in to those economies as a general rule because people want to come and be in the UK and the US. And most very wealthy Chinese people would love to leave China if they could get the money out of China. And they actually have, representatives of very wealthy families that are in Birmingham and Scotland and all over the world trying to work out what assets they can buy that would meet with the approval of the CCP such that they can get the money out. It's different in Hong Kong, as we've seen lots and lots of people from Hong Kong coming into the country on the overseas scheme who have bought, actually, as it goes, over 100 billion in net wealth with them. That's not happening to China. That's happening to the UK from China, effectively. So it does put you in a slightly different position. So I don't think it is as bad as a Ponzi scheme, but the problem is you have a 2008 event, and really it should take 20 years to get over it. We don't have 20 years because we get to a referendum where everybody panics a bit, and that costs some money. And then we have a pandemic. And really, pandemics, if you look back historically at what that does to economies of major nations, because obviously there have been big pandemics in the past, they take 40 or 50 years to get over. So we've had a 20-year problematic event followed by a 40 or 50-year problematic event. So just increasing the GDP at all. So it has acted as a cushion. You're right in that way. It's acted as a cushion so that we haven't had to take all that pain that we otherwise would have taken if the government and the central bank hadn't intervened.
I have no doubt that for as long as fiat currency is being trusted upon and asked the people believe in that, in whatever the slogan is for the fiat currency, and it's not pegged to gold, then yes, this problem is not really a problem. We'll always just service the debt, print more money, and stimulate the economy. That's not a problem. But then I really like one of the posts you posted recently on Instagram, which showed the interest rates in history and how everyone's whining about interest rates today. 1998, people were getting interest rates of 7.99%, approximately, something like that. But back in 1990s, you could even pick up a house in London for like a couple grand, 2,000-3,000, maybe 5,000 pounds in 1990s. Today, $500,000 or so. And interest rates in COVID time, the base rate was like 0.1%. So you can get a mortgage for like 2 or 3%. So in our lifetime, do you think perhaps you and I are ever going to experience a time where people stop having faith in fiat currency, which brings this whole system down?
It's a really good question, because obviously that sort of thinking is what has fueled a lot of the crypto movement. And actually, I don't know if you've been involved in that at all, or you've observed it, or I'm sure you've at least listened to a few people talking about it, because it's an incredibly interesting subject. And that wouldn't be able to do what it had done if people didn't have their doubts in the system. And of course, there are things that go on that people behind closed doors that would make both of our toes curl, that are crazy. Will people lose faith in money? I don't know, because there is no, what's the substitute? Crypto's not the substitute, because what happens if Bitcoin or Ether is to become the reserve currency of the world? Well, there's only a fixed supply of it. So the price just goes up and up and up and up and up and up, and up like this. And then people are priced out. They're crowded out of the market. And you can buy things for 0.00003 Bitcoins or whatever. But there's still multiple reasons not to prefer Bitcoin over traded cash. So who calls the shots? And it's really the cart and the horse. What comes first? Does a movement like crypto undermine the central banks? Or you see the way they've reacted. They've started with their own central bank digital currencies because they know that this is important stuff, right? Or does the system do a worse than 2008? I mean, what were people most scared of in 2020? Were they most scared of money and the financial system collapsing, or were they most scared for their own mortality and they were going to die because there's a mystery virus out there? And you could argue, well, maybe the government did their bit to persuade them that that's what they needed to concentrate on. And don't worry about the money, because there's furlough and there's bounce back loans and there's all this. We can just nearly give you this money for free, at least with the loans you're supposed to pay them back, although obviously there'll be insolvencies where people don't pay them back. So that they can always go back to the well for more, but they do need to. You can obviously imagine a scenario where you get a crisis on top of a crisis. We were close to that this time last year when we got to the energy price crisis of winter 2022, because we already had inflation, we already had rates rising, then we had a change of government, and suddenly we had a chancellor and a prime minister who basically said, I don't care what the Bank of England say, I don't care what the Office for Budgetary Responsibility say, this is what we're doing in the budget. And then you remember what happened, the international bond markets went crazy and said, these guys are crazy, we're going to sell off all our UK debt. And so the yields on the UK debt rose gigantic amounts in nearly overnight, which then caused problems in the mortgage markets, caused problems with lenders, but in a funny way, actually pricked the bubble that there was that had built up on the back of COVID. And now this year, what we've seen is that bubble has relatively slowly deflated, and we're probably now at a place where real estate represents good value again, because there's been so much inflation. And that's what everybody forget. No Bitcoin. How does inflation work with Bitcoin in the system? It's not a question I can answer, and it's not a question I've ever heard anybody else answer with any meaningful skill. So to change the regime to that extent, I mean, the big changes we've had, you mentioned, coming off the gold standard, Bretton Woods. Remember, only 25% of the currency was actually underpinned by gold at the time. It wasn't 100%. And they pretty much knew by 1969 that money that they said was in Fort Knox in gold wasn't there. And that was a big driving factor in Bretton Woods. And then fiat currencies have always failed if you go back long enough in history, because everybody figured out that if the king or the central bank or whoever goes, right, in my chest, I've got all this, I've got the money, trust me, really. Money's always been based on faith and belief, really. It's just, sometimes we've believed there's enough gold underpinning it, whatever. There isn't something, the world's monetary system is 97% credit and 3% actual hard physical assets. That's the ratio. Imagine unwinding that balloon. It would be absolutely devastating.
Disastrous for everybody. Yeah. But if you look into history, there was a time people used shells and pebbles as money.
Sure.
They used cows and goats as money. Then came gold and silver. I think that's always been there. Yep. Now you've got the fiat currency. Have you ever given it some thought that if there was going to be a substitute, what could it be?
Well, as I say, I think it's really difficult because obviously you've still got gold and silver. And I think one of the things you would see if there was a real shake in the system, and they call them gold bugs. You can listen to lots of people on YouTube talk about them. People who strongly believe that gold is going to go to 10,000, 15,000, 20,000, 50,000. You would get a bit of a warning, I think, of what was going on, because you would see the gold price escalate very, very quickly as people really tried to take cover if they lost belief in the system. But, in the world of no fiat, I suppose to an extent, you go back to barter, which would be a significant problem. Financial institutions would collapse. It would be the equivalent of a nuclear war, but potentially worse, because a nuclear war would only destroy a city or a few cities, whereas this could destroy the entire nation. And you would see social unrest at a level that is unbelievable, because everybody, the entire middle class would be wiped out.
True.
Because majority, there's two big £10 trillion plus stores of wealth in this country, right? And the top one is property. So imagine if you took that away overnight. We only owe 20% loan to value as a nation against the property that we've got. So there's all that equity there on paper, almost everything that everybody has. And what's created the wealth effect since the 1980s, house prices going up, people refinancing against them and being able to spend, people moving up the ladder, people paying their mortgages down slowly over the course of 25, 30, 35 years, whatever. And that cycle still repeats, and it's still good, because over time, apart from anything else, because of inflation, even just in inflationary terms, if wages go up, prices go up until we build enough houses, which is booked in for absolutely never, thanks to how bad the planning system is and how resistant anybody is to changing how bad the planning system is.
It is a scary thought, but it's not to say it's not impossible. It could be done. So do you have any risk management against that in case this was to ever happen? Chances are very slim, but it could happen. That's why people now believe in the idea of crypto. Do you have anywhere else you'd like to store your money in case of something like that?
I think everybody should have some hard assets, whatever they look like to you. So that might be physical gold. You have to understand, in these sorts of situations like you're talking about, this is like 2008, but magnified 100 times over. So all the big merchant banks, investment banks, had plans for what happens if this happens. None of their plans factored in that it might be the case that if Goldman Sachs want to sell, that JP Morgan want to sell, and Merrill Lynch want to sell at the same time, and there's no buyers. And that's what effectively happened in those derivative markets, which caused such a problem. So you would need physical assets that will always hold wealth. So depending on how much money you've got, art, fine art, wine. But I think you have a situation on your hands that looks something like, have you ever seen The Purge, the film?
No.
Right. Check out The Purge. It would look like The Purge. It would be shutters down, people, the level, it would be pitchforks on the street. It would be far, far worse than anything we've seen for 500 years. You'd be talking a full-on revolt.
Do you think when there's a war across the world, like the Middle East war we see now, do you think that has an impact onto the property market in the UK?
I think it has the ability to an extent, because investment doesn't like uncertainty, right? So we have to bear that in mind. Now, if the conflict escalated and you saw Iran and the US get involved, and therefore maybe China and Russia get involved, then you'd see oil double in price probably. And that would have an impact because that would feed through into inflation, and that would feed through into inflation when we've already got inflation, and that would be problematic because interest rates would have to go up more, and that would endanger the credit situation. So there is a black swan possibility there of something like that happening. That is possible. It looks unlikely because you end up in the same conversation you're always in, a bit like a nuclear war conversation. Well, if you press the button first, it doesn't really matter because it's mutually assured destruction. And if America believed that China and Russia would get involved, they're not going to get involved. And if Iran believed that America would get involved, they're not going to get involved. So, or Israel is left to defend itself because it's always set itself up with this, pretty gigantic might for a small place with enough missiles and enough troops to defend itself. And America would have to say, yeah, we're not going to get involved, which is a much, much more likely outcome. But there's always risk. And when there's already an underlying situation, like there is with inflation at the moment, then from an economic perspective, you have to be cautious. And it's much easier to take a pandemic when actually things weren't going so badly. The country felt pretty good about Boris Johnson getting elected. There was investment. The first few months of 2020, actually the housing market was very positive. Looked like we were going to go into a reasonable time. And then when the problems came, we'll do whatever it takes. And everybody trusted the process, trusted the system. They pumped in £450 billion in 2020. And the net worth of the nation went up by £950 billion. So in many ways, we gained a net £500 billion in 2020. Where did all that money go? Where did all that growth go? Property. That's where it went to. So is that real money? Well, we discussed earlier on, it's not liquid unless you know what you're doing. You could bridge against it or something like that. It's not liquid, but the money was there and that kept the people happy to a large extent, But now we're paying for that $450 billion that was pumped in 2020.
That's true. I've heard of a quote that you may have heard of as well. The higher you climb, the larger the fall. You're everywhere from what I gather now. Property, care homes, so many other businesses. How do you deal with stress?
Great question. I certainly realised during the pandemic, I've got 3 young kids as well. So I got to a stage where I was working very hard and I didn't really take care of myself particularly. And that's not a sustainable situation. And one of the benefits for me of the pandemic was having a bit of time to reflect on that and think, right, I need to make a few changes to my lifestyle and work it out. And I think some of it is routine, and I'm generally quite creative. So routines, for years I thought I hated routines, and I thought I don't want to do them, I don't want to get involved in them. But really I've now started to get into routines that are positive for me, that do positive things for me. And that can be really, really small things, such as first thing that I do when I get up in the morning, and just making sure that, there's a big, big link between mental health and physical health. So making sure, me personally, I'm not an avid gym goer or anything like that, but I make sure that I get my exercise in terms of walking, go out and take the dog out for a walk very early in the morning. Good way to start the day. Nobody out there, no cars on the road, whatever. And this time of year, it's not so great because it's pitch black. In June or July, it's quite fun because the sun's just about to come up or whatever, and that's quite a positive. So I try and make sure that I work that into the routine and try and look after my body better than I had done whilst I was really building the business to where I got to. And also, I try not to think too much about comparing myself to other people. If I have to sell off 100 properties tomorrow, right, hopefully not at a discount, but if I had to sell it, it wouldn't bother me. It wouldn't bother me. I am not the sum of the number of properties that I've got or the number of businesses that I've got. They are out there ultimately to serve me and my partners, my investment partners, and to make sure that we're in the best position we can be in. So if it becomes unprofitable to hold them, then we would get rid of them, because that's business. And if anybody who's run any business that tells you everything goes right every day, they're lying. You have to deal with what comes at you. So property I chose, going back to the start of the conversation, I chose it because it was stable. Everybody needed it. It has, when we're talking about crypto, the thing that's always bothered me about crypto is there's no utility apart from illegal transactions, really. There's no utility. What use is crypto? It's slow. It has high transaction costs. I already have a bank account. The only reason for me to use it that I could ever see was stuff that I didn't want to go in my bank account, right? Which means the dark web, generally speaking, right? And people who believe that the system's going to collapse. And look, I'm not against the idea of owning some crypto as a bit of a hedge, but compare that to the utility of a property. If you own a 1-bedroom flat and everything goes wrong, you've still got that 1-bedroom flat, right? If you owe no money against it, even better. All you got to do is be able to pay the council tax, right? and the bills, and you've got a roof over your head. So the utility within property is so incredible, and that utility is getting bigger and bigger in comparison, because we're building so few homes. Construction sector's in a recession. It's not talked about very much, but it's shrunk massively. It's going to carry on shrinking in the next 12 months. People aren't stopping coming to the UK. More people than ever came last year, right? Net migration. So you've got supply and demand out of control in favour of the landlord and against the tenant. And whilst legislation and certain other things probably aren't moving in the direction that landlords would like them to, you've got inflation pushing people's wages up, so people can afford to pay higher rents than they've ever paid. The problem you've got is that the bank is taking all of that uplift and then some if you're on a floating rate mortgage, because you didn't necessarily fix, and you got lulled into the false sense of security of having very, very low rates for so long, like we did between 2009 and 2022.
That's true. I really like what you said about not being emotionally attached to your business, because that's where a lot of people just go downwards. So Adam, how do you spend most of your time during the day?
I'm not very big on like the typical day or the typical week, because for example, today I've come here, So if it's an office style day, that will be about communicating with the team, showing my presence, seeing where the bigger problems have been, how we can fix them. I'm massive on continuous improvement. So if something's gone wrong, let's not shout at whoever might have got it wrong, especially if we haven't even got all the facts, right? Let's fix the problem and make sure everybody will know what to do if that problem comes up again. Is the problem solvable? If not, what are we going to do about that problem? And the problem is, if you like you said, the busier you get, the more problems there are in different things. So you have to have great people in place that you've got kind of a consultative role with. So you almost have an arm around their shoulder so that they can know what to do themselves. And if they don't, they know they can pick up the phone, and if they need to. So it might be, I've stopped working much like I was historically working incredibly long hours, and I've cut back a bit on that since the pandemic. Some of that I've been able to do by doing fewer larger deals that are sometimes longer and take a bit more stress to get over the line. But once you've got them, it's a nice bolt-on addition to the portfolio, rather than historically dealing with the traders. I was buying individual 1 and 2 houses. So to do 100 units was a lot of work, 100 pieces of conveyancing, 100 mortgages. Like I said, there are downsides. There are downsides as well as upsides to that. But the beauty of the houses is, if you want to sell one, you can pretty much just bang it on the market and somebody wants to buy it. Even in a market like 2023, it's not been as bad as a lot of the papers would have had you believe. So I don't know, that's not a great answer to a typical day, but I don't really, apart from those routines that sort of bookend the day, try and be at home to make sure I can read the kids a story at night, try and make sure I get some exercise first thing in the morning. Apart from that, I could be driving to, the East Midlands or the North East or something and back. Could easily be happening, to go and check on something, or to go for a meeting, or to go and look at a property. It could be, quite a boring day. It could be on the phone the whole day. I have days like that sometimes where there's just 7 or 8 phone calls to do. It could be signing some documents and going through, a ton of paperwork because we're doing 16 remortgages or something like that. That can also happen. So,
do you read a lot?
I do. I listen a lot more than I read though these days. A lot more. So I do like reading. There's so much content out there these days. It's hard to focus on what you want to do. And I do find, I think YouTube's the best resource ever. I wish there'd been YouTube when I was a kid, because the amount I feel that I could have learned if there was YouTube would have been, 20 times what I learned from reading books probably. So I read a lot of books, but it's not something I normally choose to do these days. I read a lot of articles on the internet and a lot of things that various people post. But like I say, I consume more listening when I'm out walking the dog, or even to go to sleep at night, than I must do 20, 30 hours a week of that. But some of that is also to stay current with what's going on in the global markets so that I can take an informed view, because I'm sitting in that macro seat saying, right, okay, like you said earlier, we've got quite a lot of debt. We need to be responsible about that debt. Do we need to change something in the next? If we do, if I've got 3 or 4 years to do it, I haven't got to do anything in a hurry, and I haven't got to take any losses, or I haven't got to pull the plug on anything. I just go, right, okay, we need to get from there to there to there. How are we going to do it?
That's true. It's about being proactive. Adam, it's been so useful and valuable to have you on the show. So again, once again, thank you so much for coming down. I'm sure the viewers will have learned a lot from what you do on a day-to-day basis, hopefully achieve the level of success that you have. So what's the best way for the audience to get in touch with you if one wants to do that?
So I'm Adam G. Lawrence on LinkedIn. So connect with me on there, follow me on there. I've also got my own YouTube, which I call Proponomics. So it's like a mash together of property and economics. And I post a couple of bits of content a week on there as well.
Amazing. So your details will be added in this video in the description below. Once again, thank you very much.
Thanks for having me.